Mhm.
Keith, Keith, Keith.
Yes.
This is Deborah.
Hey, Deborah.
Thanks for getting back to me about the Thursday meetings.
You're welcome.
So I'm hoping for great success. My niece and nephews are getting tired of me.
Uh, yeah, you will be successful.
Okay,
Just
either
without,
way.
either way, you will be successful. Mhm.
Morning, everyone.
Morning, Miss Archer.
Good morning.
We're just gonna wait because it's the first session, so some people maybe navigating their way here still. So. Is it raining up by you, Miss Archer?
Yes, it is. It's been, rainy, kind of, a hard shower here and there, nothing steady.
Yeah. Yeah, it's strange because it's completely missed us. It must just be north of us. They kept saying it was going to be raining all day yesterday and today, and we've had nothing. So,
Yeah, we got rain yesterday too.
yeah, yeah, it's funny. We're just a little bit south, so. Ms. Archer, so it's 10:08. Do we want to begin or,
Yes, let's start.
okay. Do you want to say something or?
Oh, just
No.
welcome everybody to
Right.
Bridge to Wealth as we start our fall winter series, Saturday series. Everyone should have received a new kind of flyer with the upcoming meeting dates. So we're just looking to to get information, to get knowledge in order to build generational wealth. And please don't forget to share it with any and everybody. We want as many of our family and community members, neighbors to join us in building wealth. So welcome, and I'll turn it back to you, Professor Key.
Thank you. So Ms. Archer is from the Sean Carter Foundation, and we want to thank the Sean Carter Foundation. They've been wonderful partners. We're growing that relationship, but our interests are truly aligned, and the foundation has been great in spreading the word. Okay, so again, my name is Keith Weigel. I teach at the Wharton School. I've been doing Bridges to Wealth now for over 8 years. And again, this program is going to show you how to generate higher wealth. Again, understand our only goal is to increase your wealth. We're not being sponsored. We're not being paid. We don't charge for our services. So again, all we're trying to do is show you how to increase your wealth. And again, one thing that I've sort of learned from teaching all these years there, people overestimate how difficult it is to accumulate wealth. And it's really quite easy if you understand what the process is. And so we're going to go through that process. Again, Bridges to Wealth in partnership with the Sean Carter. We provide free classes. Again, we never charge in financial empowerment and entrepreneurship. These are two ways where we can show households how to increase wealth fairly quickly. After our education, so the first hour of our session today is education. And then after you've been through our basic education, if you want, we have a weekly meeting where we give you further education and we, talk about the market and so forth. So again, that will happen from 11 to 12 today. So from 10 to 11 days of education. And then you're certainly welcome to sit in on the 11 to 12, and there will be more education and more about what's going on in the market, as you'll see. So as you go through the program, we're trying to increase your knowledge of the market because that's important for people to feel comfortable when they invest. Okay. Again, we've been doing this for quite a while. I used to do a lot of field research, and so we do have evidence-based findings, which I'll go through. So again, part of our program is long-term engagement. So we've had people who have been with us for over 8 years. And so again, we can sort of see how they change their behavior over time. And so this is a survey that we did, and you can see we have very, very strong results. Like 98% report a change in how they're making investment decisions. 91%, they better understand the market. 90% are saving more money, and so forth. 82% feel more comfortable when investing as part of a group. And this is true when there's a lot of uncertainty, right? If you haven't invested in the market before, there's a lot of uncertainty. It's, people feel more comfortable if you meet as a group, and, that's why we do meet as a group. And we keep giving you support and guidance. Okay. And you can see 82% feel more comfortable. 4%. This is a rough measure of how many people they take our class and then they go into the stock market. So again, a very high percentage. And 69% control. I'm not sure. Sorry, I'm gonna have to decline this. Someone's requesting remote control my screen, but I think I will decline it. No person. Okay. We have a high school and a parent program. Again, this is just surveys from the parents. Again, 1 to 5 scale, 1 being strongly disagree, 5 being strongly agree. And you can see we have very strong results. Because again, we're going to give you information to teach you how to generate higher wealth. And again, we're very proud of this, right? So anyone who's taken our program is willing to recommend it to others, every single person. So, that tells us something about the value of the program. Okay, so we're going to talk about wealth. So let's talk about how we measure wealth, and then let's see how is the country doing as a society in terms of households generating. So again, wealth is classically sort of measured by what's called net worth. And net worth simply is what do you own minus what do you owe. Right? So it's just assets and liabilities. So we're going to add up everything you own. We're going to add up everything you owe. We're going to subtract. And then what's ever left is your wealth. And as you get older, right, even when we're going to high school, right, if you have like a Game Boy you can sell, anything you can sell for more than, a penny is part of your wealth, right? It's an asset. You can sell it. So one way you can think of assets is, anything you can sell for a penny or higher. Now, as you get older, you acquire bigger assets, right? Like houses and stocks and bonds. Maybe you have a savings account. So again, how do we measure wealth? What do you own? Again, what is the sum of the assets or the sum of everything you own? And the sum being, if you sold that today, what would you get for it? Right? And then we're going to subtract all your liabilities, all your loans, all your credit cards, and so forth. So here's an example, right? So this person owns a home for $290. They have a mortgage for $170. They own an automobile, which is worth $35,000, but they have a loan for $22,000. Investment in savings, they have about $117,000, but they have a credit card and a bank loan for $47,000. So again, we're going to take everything that they owe. So again, it's a house, it's a car, investments. And we're just going to add these 3 together, and they're going to subtract out everything that they owe. They have a mortgage, they owe on their car, and they have credit card debt. Right? So all we're doing, and this person's wealth would be about $203,000. Right? Because again, and what does the $203,000 represent? It represents assets that they own above what they owe. Right? So if your assets are equal to your debt, then your wealth is 0. Okay, a couple of things when we look at net worth, just so we understand each other, right? You can see how people may look like they're really wealthy, but they're not. So a lot of people just measure wealth by, oh, well, that person drives a big car, or, that person has a big house, or, that person does this, has all these clothes. Okay. But you can have lots of assets and not be wealthy because you have lots of liabilities. So again, you don't want to measure the wealth of a person just by looking at their material goods, because they may owe a lot of money on it. The other thing with wealth is it's almost like the Chinese used to call it the twin handles, right? We have two ways of manipulating our wealth. We can either increase our assets or we can decrease our liabilities. And the good thing is we can do both at the same time. So again, if we can do both at the same time, we're increasing these while we're decreasing these. You can see how your wealth can change relatively quickly. And the last thing to understand about wealth is income is not in here. You don't see anything about income. I would probably guess, and this is just speculation, that the majority of people believe you get wealthy through your income. And that's not true. You get wealthy through how well do you invest your money. So you can have low to medium income and still be wealthy because you invest your money well. And there's lots of examples of this. So again, we don't get wealthy by always increasing our income. If we invest our money better, and when I mean better, we get a higher return for it, then that's how we're going to generate wealth. And that's how most people do generate wealth. If anyone has any questions, just interrupt me, please. Okay, so now we want to look at the wealth gap. And again, unfortunately, the country's been terrible in terms of wealth distribution. It's not only, our country, it's most countries. We're only, wealth is concentrated on the very, very few. But there's different ways we can look at wealth. And one way we can, look at wealth is, well, how about by, ethnic background? So if we do it that way, right? So if we took all the white households and we lined them from richest to poorest, the middle household would have a wealth of about $187,000. If we did the same thing with black households, the middle household would have a wealth of about $14,000, though I've seen this as $24,000, but still, so let's say it is $24,000. You can see there's still a big gap there. And if we looked at Hispanic households, the middle household would have a wealth of about $31,700. So you can see there's a big gap between the wealth of white households and minority households. And in fact, this gap has been growing. This gap has been growing. So minority households are falling further and further behind in generating wealth. Okay. Now, why is this so important, or why do we think it's so important? Well, it turns out wealth is sort of like the central node in our society. And a disparity in wealth causes a lot of other disparities. So we certainly know if there's a wealth gap, there's a health gap. There's evidence that shows the health of a household depends on the wealth of a house. Again, we know that there's a wealth gap, so we're seeing the health gap. We're certainly seeing that in COVID. There's a gap in education because low wealth households do not have the resources to spend on their children's education. There's a gap in home ownership. A significantly lower percentage of minority families own their own home. There's a disparity in the criminal justice system because low wealth households can't afford the legal help. So wealth, really affects a lot of the other injustices in our society, and that's why we want to focus on wealth. Okay, so again, our premise is going to be, first of all, generating wealth is not that difficult. And two is, we're going to generate wealth by investing our assets better. So we're going to create assets which give us a higher return. And this is pretty much what our program is based on. So this is the wealth pyramid in the United States by household. And basically you can see about 60% of the US households have a wealth less than $50,000. Minority households are overrepresented in this segment. And then this is sort of the investing pyramid. And if you look at how they invest, well over 90% of them only put their money in banks. And we're going to see banks, you can't get wealthy putting your money in a bank because you don't have the compounding power. So what we have found is in low wealth households, there's lots of very good savers. They save, a high percentage of, their income coming in relative to people who have more money, but they don't get wealthy because they're not investing it, they're putting it in banks. For the last decade, your return in a bank has been about 1%. The richest 40% of US households, overrepresented by white households, a significant percentage of those households have their money in the stock market. And again, the stock market returns around, well, it's really over 8% a year for over 120 years. So one reason we see the wealth gap keep growing, right? It's just mathematics. Low wealth households are getting a return of, very, very low, 1 to 2%, let's say, while high wealth households are getting a return of over 8% a year. I mean, that's a big difference, as we'll see. And again, that's one reason the wealth gap keeps growing. So a couple things, so one thing that we thought about is, well, geez, why are all these households satisficing for like such a low return? I mean, they're passing up a return of 8% and they're just thinking, oh yeah, I'll take one. Oh yeah, give me two. I'm doing well now. I mean, that doesn't quite make sense. And the other thing is, when you ask people, especially wealthy people, they'll say, well, the stock market is only for the wealthy, right? The stock market is only for the wealthy. Yeah, it's too risky for low wealth of individuals, is what they're saying. But we want to understand they're wealthy because they're in the stock market, right? They didn't get wealthy and then go into the stock market. They're wealthy because their money's been in the stock market, sometimes for generations. So what we have found is a lot of the low wealth households are not in the market because they just don't understand how it works. And, most schools don't teach that. So our program is simply based on education, and then we're going to support you and give you the opportunity to invest your money in higher return assets. Okay, so again, the driver of wealth is what's called compound interest. It's just a mathematical function, really. Okay. So let's understand what compound interest is. So again, basically, compound interest is your money making more money for you And usually you're just sort of sitting there passively or almost passively. Okay. So for example, let's say you put, $100 into an investment and you get a 10% return a year, right? So in 1 year, right, your money's sitting there. You're really not doing anything with it. You're going on with your life. And then at the end of 1 year, you don't have $100, but you have $110. Why? Because your $100 earned you a 10%, which is a $10. Again, you just put in $100. You didn't do anything. It's just sitting there earning money for you. And at the end of the year, now you have $110. Well, let's let it sit there again, right? But now we're going to get in interest not on $100, but on $110. So what we put in plus our previous interest. So now we're going to get $11, $10 from the money we originally put in, and $1 from our interest, which we previously earned. So all compound interest means is I'm getting interest on the interest I previously earned. That's all we're doing. Well, a couple of things, just in this simple example, right? You can see the interest you earn grew from $10 to $11. And if we did it a third year, it would be higher than $11. So one rule of investing is, again, and this is simply because of the math, the longer you have your money invested, the quicker your wealth is growing. Again, the longer you have your money invested, the quicker your wealth is growing because you have more previous periods of interest. And those are earning you more interest. Okay, and this is why we say that compound interest is the driver of wealth. Because again, even as you go around, your daily life, your money is earning more money for you. And the longer it's there, the quicker your wealth is growing because you have more previous years of interest to build upon. Okay. So what does this mean? Well, this is a table that we use when I go to high schools. And basically what it says is, okay, let's invest $1,000. We're only going to take $1,000 out of our pocket. And then we can invest it at 5%, 11%, or 15%. And then we can leave it in for various periods of time. So you see, if we take $1,000 out of our pocket and we leave it invested for 20 years, if we invest at 5%, we turned our $1,000 into $26.50. If we get a return of 11%, our $1,000 is now worth $8,000. If we can get 15%, our $1,000 is now worth over $16,000. And we just put $1,000 in the market. That's all we put in. So again, you can see the higher your interest rate, the higher your total fund at the end of a specified time. And now if we go down to 50 years, again, high schoolers, right? High schoolers, most of them will live for 50 more years. You can see this $1,000 at 5% in 50 years would have turned into $11,000. At 11%, it would have turned into $184,000. And at 15%, it would have turned into over $1 million. And all the students would have taken out of their pocket is $1,000. So clearly you can see the longer your money is invested, And the higher your rate of return, the higher your total investment fund. And again, if you start early, really early, like if you have children or grandchildren, then, you know, you can put in small amounts of money and they can be very wealthy because you're trading time for money, right? But even if, even if, 25 years, again, you can see that you can turn $1,000 into, this case, almost 33,000. Okay, so this is how you're going to get wealthy. You're going to invest in these high return assets, and you're going to try to leave your money invested for as long as you can. Okay, so there's this rule by Einstein. Einstein actually did a lot of the work on compound interest. Compound interest really fascinated Einstein because he understood, being Einstein, that compound interest was a way for people to get wealthy. And so he did a lot of the mathematical derivation. And this, in fact, is one of his theorems. It's an interesting theorem. It's called the rule of 72. If you take the number 72 and you divide it by your rate of return, that's going to tell you how many years it will take you to double your investment. Again, and this works for any investment. Again, just take the number 72. Again, you can look at the mathematical derivation of why this is true and divide by your rate of return. And the number that comes out tells you how many years will it take you to double your investment. Okay. So again, you put your money in a bank. 1%. I mean, even today, if your money is in a savings account, you're getting probably 0.5%. I mean, I talk about it, in the second hour, but, you really want to, shift your money from a savings account to at least a high yield savings account, because that's going to be paying you over 4%. But so again, you leave your money in a bank, you can see 72 divided by 1 is going to take your entire lifetime to double your money. Again, no matter how well you save, you cannot get wealthy putting your money in banks. You don't have the compounding power. It's that simple. Again, the market has returned 8% for 120 years on average. So you can see when your money's in the stock market, it's going to be doubling on average every 9 years. I mean, over the past 10 years, even with the market downturn, your money has tripled in 10 years. That's how well the market's been doing. So again, you can see why the wealth gap keeps growing. I mean, again, there's lots of reasons, but this is a prime one. Because if you invest your money in the market, you're doubling on average every 9 years. You put your money in a bank, it's taking you your lifetime. Okay, so let's see what the real difference is. Okay, so we're going to take $1,000. This is just a compound interest calculator. You can find them on the internet. We're going to take $1,000. We're going to put it in the bank, and then we're going to put $200 in every month for 40 years. This is our long-term saver. So after 40 years, the person will have put $97,000 away, which is this gold triangle here. And their $97,000 will have earned them $22,500. This is silver sliver. But again, you can see it's getting wider, right? Again, what does that mean? Well, it means that your wealth is growing at an increasing rate, right? Because if it was a constant rate, this would all be parallel here. Okay. So at the end of 40 years, our saver has about $120,000. Okay. Now we're going to do the same thing, take $1,000, but we're going to invest it in the market, 8%, 200 a month for 40 years. Again, this person also puts in $97,000, which again is the gold triangle. Okay, but now because this person put it in the market, their $97,000 has earned them almost $603,000, which again is this green area here. Notice this green area, now we can see it because we have the compounding power, right? We have this slope, positive, upward sloping, and you can see it's getting steeper and steeper as we go out in time. Again, this is showing you that your wealth is increasing at an increasing rate because this slope just keeps getting steeper. And this is why, again, at the end of your career, you can see, you know, if you put off retirement for 1 or 2 years, it can be of huge benefit to you because your rate of increase in your wealth is so high because you've had it invested for so long. Okay. So again, we all know that's a huge difference. And I just want to point out, look at this person put in 97,000. Whoops, sorry. And this person put in $97,000. Again, they both put in the same amount of money. But look at the difference in the money that money earned them. Right? 22,005 versus 603,000. Again, so it's you know, you don't get wealthy through income. You get it by how well do you invest your money. And you can see what a huge difference it can make. Okay, any questions on that? So again, compounding is a driver of wealth. It's just mathematical. Okay, so why are we going to talk a lot about stocks? Well, it turns out that the stock market is probably the easiest way to get wealthy by investing your money. So let me try to show that to you. So this is a graph. This is value, dollar value on the vertical. And on the horizontal, we have about 88 years of data, 1925 to 2013. And we have different asset classes. Okay. So what this is going to show is it's going to show you for every dollar you invested in 1925 in each of these classes, how much would that dollar be worth in 2013? So this blue line represents what we're going to call large cap stocks. And, you know, this would be the S&P 500 index. So every day, you know, even if you listen to the news, they'll talk about what the S&P 500 did. So this is what they're talking about. The S&P 500 are 500 large companies. So for every dollar you would invest in the S&P 500 in 1925, each of those dollars would have been worth about $300 in 2013. Today, each of those dollars would be worth north of $400. Okay. Long treasury bills, these are 10-year treasury bonds. Again, a treasury bond is simply a debt obligation of the government. So you could go to the bank on Monday and take $10,000 and say, I want a 10-year treasury bond. And you would give the government $10,000 and the government would guarantee you that they would pay you some interest rate. Right now, it's over 4%. And then at the end of 10 years, they would give you your money back. 10 years. 10-year bond is sort of the benchmark. As we'll see, most of our interest rates on credit cards and mortgages are based off the yield on the 10-year. So for every dollar you invested in 10-year bonds in 1925, each of those dollars is worth about $9.50. T-bills are just 6-month bonds. So you go into the bank and you say, hey, I want a 6-month T-bill. You give them, let's say, $1,000. They'll give you 10 T-bills. Usually T-bills are worth $100 a piece. And then in 6 months, you can turn them back to the government and you'll get your money back plus interest. Okay. So for every dollar you invested in T-bills in 1925, each dollar is worth about $2.30. Dollar for every dollar you left at home in 1925, and you didn't invest it, you didn't put it in a bank, you just left it under the mattress. For every of those dollars, each of those dollars is worth less than 15 cents today. Again, why? Because of inflation. So understand, any money you keep at home, right, is losing value. Is losing value because it's not earning you any more money. And then you have inflation. Again, inflation simply means the cost of goods are going up, right? So, I mean, when I was a kid, you know, a bottle of Coke, 12-ounce bottle of Coke, using the same formula, using all the same raw resources, the same size as a 12-ounce bottle of Coke today, I paid a dime for. And today it's, you know, usually about $1.50. It's the same product, the same size, everything's the same, but the cost of raw materials has increased. Again, that's what inflation does. So you never want to keep a lot of money at home, right? So when Senator Menendez says, oh, I was keeping $500,000 at home because they didn't trust banks. I mean, yeah, come on. Come on. I can tell you, you know, all that money was losing value for him. So, okay. And then if you invest your money in gold, for every dollar you invested in gold in 1925, each dollar was worth about $7.50 in 2013. So you can see in the long run, stocks dominate in terms of generating wealth in the long run. Okay, so so we're going to say, oh yeah, you should, you know, be buying stocks, and where'd you buy stocks? We'd go to stock market. So let's think about what is a market and what is a stock market. So a market was developed basically to facilitate trade, right? So, you know, when there were not that many, you know, humans around, right? And let's say I had apples and another farmer had corn, we could go to each other and trade. I would give him some apples, he would give me some corn, right? But when you get 10 people or scores of people or hundreds of people or thousands of people or millions of people, you know, it's hard to coordinate. So the humans started coming up with this idea of a market. And again, a market is just a coordinating mechanism. It allows people to coordinate, right? So markets in towns, right? We started having Saturday markets where farmers would, you know, come in and bring their produce to the town square, and people would come and shop. Again, it's a market because people knew on Saturday morning that farmers were going to be there selling. So again, markets were developed by humans to facilitate trade, and they're just coordinating mechanisms. Okay, and again, it basically lowers the you know, coordination costs because I know where to go now to trade.
Professor Keith,
Yeah.
there is a question in the chat, and there's somebody waiting to be let in.
To let in?
Mhm.
Yeah, I haven't gotten that.
You didn't see it?
No, let me see participants. All right, hold on one second. Yeah, I don't have a waiting room here,
Okay.
unfortunately. So,
I'll tell
sorry.
you to go back. I'll tell you to go back and try again.
Okay. So if I start investing late, then I need to put in more money per month. Yeah, again, exactly. Well, to reach the same amount at the end, yes. But you're still pretty young. So I wouldn't worry about it. You only have to worry about when you're as old as me. And then you worry. But again, 20 years is a long time. So, okay. All right. So let me just make this bigger. Okay. So again, a market is a social institution. It helps coordinate. There's millions of markets. We use markets every day, right? I mean, if I want coffee, I go to a Starbucks. Well, I don't go, but I could go. Okay. Why? Because Starbucks sells coffee, right? That's why we have names on shops. Just think if we didn't have names on shops, we'd run around the city, going into different spots. Hey, do you sell coffee? Do you sell coffee? But you wouldn't have to do that because we have a coffee market. And we know there's coffee houses and they're called coffee houses. So you're used to going into markets. We use markets every single day. And again, and then a market is economic exchange. Oh, I want coffee. Let me go to, let's say Starbucks. Okay, I'll give them money. They'll give me coffee. There's your economic exchange. So a stock market just sells stock. And what is stock? Well, this was called the stock certificate. So when I was growing up, and even probably even I was in college, they were using stock certificates. So when you would buy a stock, so this you can say is Google, right? So if you went to the brokerage, and back then you had to tell your broker, hey, buy me 10 shares of Google. And the broker would put the order in, and then you would get back this certificate. These be real fancy. It would say number of shares 10. It would say 10 here. This is the CEO. This is our CEO. And this would come in the mail, and this would prove that you own 10 shares of Google. Okay. And then when you wanted to sell the 10 shares, you would have to sign this, endorse this on the back, like a check, and then send it back to your broker, and then your broker would sell it for you. Okay. And again, each way you would get charged at least $25. So again, you can see when you buy stock, it's a legal document. And again, when you buy stock, you're actually becoming an owner of that company. And that's why it's this legal document. So a stock certificate shows how much of that company do you own, right? What is your ownership percentage? But even if you buy a single share of stock, you're an owner of that company. So again, when you go to the stock market, you're buying ownership. You're becoming a capitalist. You're a capitalist now. Because again, if I buy Google shares, I become an owner of Google. Now, how much do I own depends on, well, how many shares are out there and how many shares do I own. And usually most of us, and when I say most of us, I'm even talking about big pension funds, they don't own a lot of this, companies that they hold stock in. Because, Apple, hundreds of millions of shares of stock. Google, the same thing. But again, let's say, Nike has 10 shares and you own 1 share. Well, now you're a 1/10 owner of Nike. and you have legal right to 1/10 of their assets, 1/10 of their profits. Again, when you buy stock, you buy ownership. It's important to understand that. So how do you buy stock? Well, again, in the United States, we're used to what's called a posted price system, right? We go to Starbucks, we say, I want a cup of coffee, and the barista says, oh, okay, that'll be, I don't know how much coffee is, let's say $5. Okay. And then that's a posted price, $5. And then we either decide, well, we accept that price, so we pay the $5 and we get the coffee. Or we say, $5, I'm not paying $5 for a cup of coffee. And we go somewhere else. So in the United States, we're used to the sort of pricing mechanism, what's called posted price. The seller posts a price, and then we decide whether we buy. The stock market's not like that. The stock market's an auction. And in other cultures, they don't use posted price, they use auctions. You go to the market, there's a farmer there, you say, oh, how much for your apples? The farmer goes, $4 a pound. And don't you think that's kind of high? How about $3.50 a pound? And you negotiate. So in a stock market, you're negotiating. You negotiate. Okay. And if you want to buy something, you're called a bidder. So you go to the market, you see, well, how much is, Apple selling for? Let's say, oh, well, I think I'll pay $100 a share for Apple. Right? That's your bid. Okay, yeah, I'll pay $100 a share. And then you have to see if any seller makes you an offer to match your bid. So you have to find a seller that will sell you Apple for $100 a share. Now, if the price of Apple is currently trading at $115 a share, you can see that no one's going to sell you the Apple for $100 a share. Why should they? Others are willing to pay $115 a share. Now, you can leave your price of Apple at $100 a share, and you can leave it there for 60 days. And if the price of Apple ever gets as low as $100 a share, then some seller will say, "Yeah, I'll take that." But if the price of Apple never gets that low, then no one's going to sell to you. So again, we decide prices in the stock market by demand, which is, oh, well, how many shares do people want at what price? And you put those prices in. And then supply, how many people are willing to sell at what price? And when bidders find sellers who are willing to trade, then a trade's made, right? So, usually when you go to the stock market, you can buy at what's called the market price. Right. So if I want to be sure that someone will sell me shares now, and the market price is, let's say $60 a share, then I'll just put in, well, I'll buy at the market price. Because I know people are willing to sell to me because there's people selling now at $60 a share. So again, a lot of us, when we, buy in the stock market, we're just going to buy at market price, what people are offering to sell for. And that's why most trades at market price will be executed within seconds. Because if you say, I want to buy 5 shares at $60, someone will say, yeah, I'll sell them to you. Because that's market price. Okay. So again, a lot of people may be confused about the stock market because it's not posted price like we're used to in the US. Now, again, before, the digital age, stock was sold in these big, what they call pits. And when I worked at NYU in the 80s, I used to go visit these pits a lot, where these individuals would represent brokers, and some would be buying, some would be selling, and they had all sorts of signals and so forth. Today it's just done electronic. So it's done by way fewer people, and it's, there's no one shouting out bids and offers. It's just put in electronic. Okay, so where do we find these stock markets? Well, in the US, there's two major stock markets. There's the New York Stock Exchange, which is the oldest, and there's the NASDAQ, which was the first electronic. There used to be other stock exchanges, Philadelphia, all major cities had one. Chicago had one, San Francisco had one, Denver had one, but they all merged and so forth. And now the vast majority, probably about over 95% of all the trading is done on these two. So these two exchanges are open Monday through Friday from 9:30 to 4. That's when trading takes place. But again, other countries also have their own stock markets. So stock markets are global. So you can go to London. The London stock market is the biggest market in Europe, even with BRICS. Okay. Or you can go to Tokyo in Asia. And the Tokyo Stock Exchange is the largest exchange. But you can go to Australia. You can go to Saudi Arabia. You can go to China. Most countries have their own stock exchange. Okay. What does this mean here in the US? Well, if you wanted to, you could trade 24 hours. Because if our stock exchanges are closed, a lot of the stocks traded here are also traded on these other exchanges. It will cost you more to trade on these exchanges, but you can do it. You can do it 24 hours. Okay, so now we have these stock exchanges, and and people started these. I mean, New York Stock Exchange was started back in the 1700s. And people would say, well, geez, I wonder how the market's doing. How's the market doing? Right? And you could point to the performance of one stock. Let's say in the early 20s, we would probably look at Standard Oil. Oh, well, how's Standard Oil? Right? But that just tells you how one stock's doing, and when there's all these other stocks trading. So these financial companies started coming up with what they call indexes. And the original purpose of the index is just to give people an idea of, well, how the market's doing. Right? So again, think about it with the Phillies, since from Philadelphia, right? If you ask me, well, how are the Phillies hitting as a team? Well, I could say, well, Bruce Harper is hitting over 300. That won't give you a very good idea. So normally I would give you the team average. This is how the team's hitting. Okay, the same thing with the stock indexes. We're going to group together a set of stocks, and we're just going to take their average. So the first index was the Dow Jones Industrial. Why is it called the Dow Jones Industrial? Because it was developed by Dow Jones. They're a financial company. They own the Wall Street Journal. And they were looking at 30 industrial firms. And this was developed back in the 1920s. Again, and why did they do this? Because the average of the 30 companies, these big companies, well, that's a better measure of, well, how the market's doing. And that's why every day they will report the Dow Jones Industrial Average. Well, 30 companies is great, but there's hundreds of thousands of companies out there. So then we got these other indexes. So Standard & Poor's, which is a different financial service company, they said, we're going to group together the 500 biggest US companies. And since 500 is a bigger number than 30, then this is really a better measure of how is the overall market doing. I mean, the only reason the Dow Jones is relevant today is because it's the oldest. Because 30 companies, it tells us a little bit about how the market's doing, but the performance of 500 tells us a lot more. So the S&P 500 is, again, the average performance of the 500 biggest US companies. Think of it this way, if 250 of these companies, if their stock price went up today, then the index price goes up. If less than 250 of these companies' prices went up, then the overall index goes down. So again, this is telling us on average, how did these companies do? And there's scores of these different indexes. So we have what's called the Russell 2000. So look at the S&P 500 only looks at large companies. So if someone says, well, geez, how do small companies do today? I mean, the S&P 500 is not going to tell you anything. But the Russell 2000, which looks at the 2,000 smallest companies, that'll tell you how the small companies did. That'll give you some idea. So, you know, people developed the Russell. Why is it called the Russell 2000? Because some financial service company called Russell developed it. I mean, we could start our own index, right? People probably wouldn't use it, but we could start it. So again, all these indexes are they're just privately owned. There's nothing special about them. Some of them get adapted, like the Dow Jones, because that's the oldest, S&P 500, because this is really looking at the health of the US economy, because you have 500 of the largest companies. Whoops. Okay, so I'll finish here today. So we're going to talk about investing in the stock market, but again, what we have to understand is it's easier than most people think in terms of getting wealthy. So what we're going to say is, if you follow these 4 simple rules, you will be wealthy. I will guarantee that you will be wealthier than if you don't follow. So first of all, you want to be more efficient with your money. And then you want to invest it on a periodic basis. So we're going to show you how to be more efficient with your money. Most people waste money. In fact, we all waste money. So again, if you can be more efficient with your money, and then because you're more efficient, take that money and invest it, you'll be much better off. Because of compounding, we've seen this. You want to start as soon as possible. Again, your children are never too young to start an investment fund for them. And the sooner you start, the better off they will be. You want to use low-cost investments, right? I said before, when I traded, back in the 60s, I was paying at least $25 a trade. So a lot of my investment value was going to the broker. So again, we want all our money going towards our investment fund. We don't want to be paying commissions. We don't want to be paying account maintenance fees and so forth. So we're going to show you how to use low-cost investments. And finally, you want to diversify. You don't want to put all your eggs in one basket. And this is sort of a basic tenet of our investing. We're going to invest in collections, not individuals. So again, we're going to invest in collections of companies, not individual companies. Why? Because it's much safer, much safer, as we'll see. Okay, any questions on that?
Yes, Keith, how do we find the recordings for these? For this session?
So we're going to post them in at least 2 places. We'll post them to Sean Carter website. Do you post them on the website, Miss Archer, or just send them to the people who registered?
We send them out to those that have registered. So if you're registered for the session, according to the list of emails that we have, we send it out to the emails that have registered through the Sean Carter Foundation.
Okay, that's fine then. I'm registered. At least I think I am. I mean, I'm here.
Right.
Okay.
Thank you.
Thank you. Any other questions? Okay, so we're going to take a short break. Let's say a 2 minute, and we'll start at 11:10, and then we'll start with the second half of the class, which would be, more investing. And this is where people go after they finish our education part. Okay, so everyone's welcome to stay. You'll be a little more advanced because these are mainly graduates of the education program. All right. See you soon. 2 minutes.
Thanks.
Yeah.
I'm in.
Okay, so let's start. So this is our revised contact information, websites, and so forth. For those of you who are new, so you can schedule a one-on-one with me. It's about 45 minutes. I can help. I help people open up accounts, talk about your retirement fund and so forth. It's free. All our services are free. I just want to make that clear. We will never charge you. So again, if you want to schedule with me, you just go to this link, pick out a time, email Lizzie. She's our operations director. You can just email her. She'll put you on a mailing list, or she'll send you information. And then we have a Thursday meeting, and this is just the link for our Thursday meeting. Thursday meeting and our Saturday meeting is, very, very similar. So this is our flyer, in case you haven't received it. Again, you can use a QR code and just to register. And you can see we'll be meeting over the next several months, usually every other week. Okay. Okay, so here's our investment choices. So for those of you who are new, again, we invest what's called index funds, and we'll talk about it next week. But we invest in index funds because they perform better and they're cheaper. And that's why we use them. And these are just index funds from Charles Schwab. And we'll talk about why we use them as an example. And this shows the price per share. This is 2 weeks ago. This is last week. And this was Thursday. Okay. So, and why we're giving it to you like this is we're trying to give you sort of a trend in what's going on in the market. Right? Is the market sort of trending down? Is it trending up? So you can see 2 weeks ago, a price per share of the S&P 500 index was $68.17 a share. Last week, it was $66.20 a share. And Thursday, it was $66.05 a share. Total market index, this is also an index, it covers the entire stock market. 2 weeks ago, this was 75.06 a share. Last week was 72.97 a share. Friday was 72.64 a share. International index, these are all non-US stocks. 2 weeks ago, price per share was 21.71. Last week was 20.95. Friday was 20.53. A balanced fund means there's stocks and bonds in this fund. So these three funds just have company stocks in them. Again, they're just collections of companies. This has stock and bonds. 2 weeks ago was 15.26 a share. Last week was 14.93 a share. Friday was 14.85 a share. This is global real estate, so this would have properties instead of stock in this fund. It has thousands of properties. So again, you can get into real estate and not own a house. And there's various reasons why you do want to be invested in real estate. So 2 weeks ago, this was $5.99 a share. Last week was $5.68 a share. And Friday was $5.56 a share. So you can see instead of spending thousands on a house for $5.56, you can buy one share in this fund and you would own tens of thousands of properties. Small cap index, these are small companies. 2 weeks ago, the price per share was $29.34. Last week was $26.84. Friday was $28.06. Emerging markets, these are developing countries, Brazil, China, Cambodia, Nigeria. These are all countries that developing a middle class. 2 weeks ago, price per share was $8.45. Last week was $8.27. Friday was $8.10. Mid-cap index, these are medium-sized companies. Etsy would be one. Five Below would be one. 2 weeks ago, price per share was $54.38. Last week was $52.85. Friday was $52.14. And finally, healthcare. This is called the sector stock. It only has healthcare companies in it. 2 weeks ago, price per share was $25.38. Last week was $24.86. Yesterday was $24.55. So you can see the general trend of this market has been on a downtrend. And in fact, September was the worst month of the year. Okay, so again, we're just trying to sort of show you how the market's going in, the last like 2 or 3 weeks. Okay, then we'll generally look at, well, how is the market overall going? This comes out every Friday, and it basically shows you the major indexes: Dow Jones, S&P 500, the NASDAQ. NASDAQ would be, again, mainly high-tech stocks, Apple, NVIDIA, Tesla, and so forth are traded on the NASDAQ. You have the S&P Mid-Cap 400, so these are 400 medium-sized companies. And then you have the Russell 2000. These are 2,000 small companies. So this is for small companies. This is for medium-sized companies. This is basically for high-tech companies. And these are for large companies, 500 largest. And these are, again, 30 companies, mainly industrial. So like the Dow Jones doesn't hold Apple, doesn't hold Amazon. It's more industrial companies. Okay, this is their total level of where it closed at. And this is the weekly change. So the first thing we want to know is, well, how did the market do last week? And you can see this is a pretty mixed bag. The S&P and the NASDAQ gained, but all the other indices lost. So again, so the first thing that we're trying to show you is, oh, well, what happened last week? It was a down week. And again, it's been a down week for the last 2 months. And then this is the year-to-date change. So you can see from January 1st to October 6th, the Dow Jones gained about 0.75 of a point, of a percent. The S&P gained 12.22%. Now remember, for the year, so we have 3 months remaining, this should be 8, but you can see right now it's 12.22. The NASDAQ, which are your high tech stocks, you can see that's up 28 1/3, right? So you can see, right, just by investing in indexes, you could get this return of over, 28% a year, right? Again, and what you have to know, well, you just have to know, well, I should put some money in the NASDAQ index every so often. That's all you have to know. And you would get a return of over 28%. The mid-cap 400 for the year is up 1%. And the Russell 2000, you can see, actually has a small loss for the year. The Dow Jones had a small loss for the year, and then it came back a little bit. Even though it lost 99, it was even worse than 99 last week. But you can see that these two are doing well. Okay. And then we're going to show you what happened the week before. So again, you can see this is the week before. Again, you can see here the Dow and the S&P 500 lost for the week. The others had slight gains. You can see, relatively speaking, right, the Dow Jones lost. We saw that for the week. S&P gain, right? So Friday the 29th, it was 11.68 for the year, up. And then you can see yesterday it was 12.22. So we say, yeah, it did better. Composite did better. Mid-cap drop for the week, we saw that, and the Russell 2000 drop. So again, we're trying to show you, this is where we were on Friday the 22nd. Again, you can see a down week. Again, September was the worst week of the year, as we'll see, and we talked about this before. Part of it is seasonality. August and September are generally your worst months. They're very weak historically. But you can see losing week, and you can see we were better off. So think of it this way, since September 22nd, the market's dropped because we were better off.
I have a question.
Yep.
What is considered like I can figure out what's the definition of the top 500 and the top 30, but what's the definition for medium and what's the definition for small companies? Is it dollar value?
Yeah, so it's what's called the market cap. So the market cap is how many shares are out there and what is the price per share today. So the market cap can change. And Apple was the first company to reach $3 trillion. So if we look at how many shares of Apple are out there, millions, times the price of Apple, it's worth over $3 trillion. So mid-cap companies are generally, I believe the cutoff is, I believe it's 50 billion. I'll check on that. So a small company goes up to 10 billion. So a small cap would be up to a market value of $10 billion.
So we're not
Mid
talking
cap,
mom and pop.
I believe are between 10 and 50.
So we're not talking mom and pop shops. We're talking still fairly significant.
Well, for the
No.
mid cap, but you can have some very small mom and pop shops down here.
Okay.
Again, it's the 2,000 smallest publicly traded companies. Generally, mom
Got
and pop shops aren't publicly traded.
Yeah, yeah. Understood. Thank you.
Okay. Okay, here we were at the beginning of August. Again, August was bad. Every week in August was a down week. So again, you can see first week in August was bad. And we're certainly off of these. I mean, look at the Russell 2000 has lost more than 11% in like two months. This is where we were July 1st. Again, June and July were good months. I mean, look at the S&P was up about 16. The NASDAQ was up almost 32. Russell, even the Russell was up, over 7. So the market's come down since July 1st, and it's mainly been August and September. Here we were, this was March 1st. Again, you can see March 1st was a bad week. Everything was down. You can see that the Dow is up. Basically, the Dow's up, S&P's up, NASDAQ is up. I mean, look at the NASDAQ is up almost 20 percentage points, right? So since March 1st, the large companies have gone up in price. The small companies have gone down though. Look at, I mean, the Russell was up over 7%, and now it's less than 0. So again, since March 1st, the large companies have increased in price. Small companies have decreased in price. This is where we started the year from. Okay, and so again, we're just up from here. Then we go all the way back to October. Okay, and basically what has the market done since October 1st? And you can see that the market's up, right? So let me see here. So on October 1st, the Dow was at 28,725. Yesterday, it closed at 33,407. Right? So what, that's 4,000, 5,000, close, not quite. S&P was at 3585, and it closed at 43,008. So, it didn't quite take on 800 there. NASDAQ, look at NASDAQ, was at 10,575 and now closed at 13,431. It's almost a 30% gain. Ignore these here because these were from 2022, sorry. So these have no meaning to us. And the Russell was at 1664 and now it's at 174.5. So clearly since October 1st, the market is still up. Okay, any questions on that? Okay, and then we're going to talk about some articles. So the first article, I just want to check something. Yeah, let me see, 4219. Okay, so this article was from the CNBC website, and it talks about how charts. So one way we can predict where the market's going is by reading what's called reading charts. And we look at the price behavior of the market or some index, and then we can predict out future prices. And this is just called charting, and there's, technical people, and this is what they do. There's very complex mathematical models that do this. So again, we're trying to predict the future based on current price movements. So Bank of America analysts are saying that we should have what's called a capitulation. And what a capitulation is that the market basically just crashes. In our case, the market crashes. So again, what happens, right, is we have buyers and sellers in the market. And again, so we've been saying since the beginning of August, the market has kept going down. So we have buyers and sellers, and at some point the market keeps going down, and the buyers say, I'm not buying. I mean, I'm done with this market. I'm done with it. It just keeps going down. I'm not buying. So basically all the buyers leave the market. And this is actually a good event because when this happens, the market starts to come back. But again, like, everyone's got to sort of give up on the market first. And they're saying, and they're predicting one. I mean, clearly, again, people's faith in the market has been going down for over 2 months. And part of the reason is, and we talk about this a lot, is the yield on the 10-year bond. So like right now, you can go and get a CD at banks and they'll pay you 5% risk-free. So you can invest your money risk-free at 5%, or you can put it in the market and maybe, in the long run, you'll make a profit, but in the short run, you may lose money. So people are saying, oh, gee, should I put my money in a bank and earn 5% with no risk, or do I risk it in the market? And again, because the yields have kept going up, more and more people are just putting their money in CDs, basically. Okay. So again, they're predicting this, the market will just collapse because all the sellers, I'm tired of it, keeps going down. But then we will have this year-end rally. Because again, when you have capitulation is when the next bull market starts. Again, September was the worst month. It's not like this is sudden here. September was the worst month. The S&P 500 lost almost 5% just in September. That's a huge loss. The NASDAQ almost lost 6%. So again, these are huge moves in a short period of time. Okay. Now, these chartists, they read sort of the up and down of the price, and they're saying that there's the support level at 43.30. So if the price gets above 43.30, it'll stay there and go higher. It's a support level. Okay. Let me see where it closed at. So it closed at 43.08. Again, this is why it's called a support level, because we have to reach that. So again, the market gained over 1% on Friday, S&P 500. It got to 43.08, but we're not at 43.30 yet. So you don't want to put too much probability that the market will keep going up. Once it's past 43.30, you can put a higher probability it will keep going up. But again, it's got to hold the support level of 43.30. If it doesn't hold 43.30, and again, it's at 43.08, so next week will be important, they see a downside risk of about 4,200 with the next support level at 41.14. So next week, as you watch the market, you want to focus on 43.30. When the S&P 500 goes above 43.30, higher probability it will hold. If it doesn't reach that and it starts to decrease next week, it could go as low as 4,200, and it better not go through 41.14. Because if it goes through 41.14, it's going even lower. So again, these are the levels you want to watch. Now, again, so if the market's going down, why do they say we have this year-end rally? Because in the stock market, again, there's this seasonality. And we have what's called the Santa Claus rally a lot, where in December, stocks just start to rally. there's several reasons why. There's, tax reasons and so forth, but history shows, right? So when we look at history and we see other years like this, so in 2012, we had this capitulation in the fourth quarter, and then we had the rally. In 2016, we had both Brexit, and then we had Trump being elected in November, right? And the market went down. But then we had the year-end rally. In 2019, we had the US-China trade war, the tariff war, where again, the market was going down, and then we had this rally. So again, it's, this does happen where the market's going down. Remember, August and September are historically just bad months for the market for various reasons, and we can talk about those at some point. So we've just been through that. So now we'll have to see what happens.
So, Professor Keith,
Yeah.
So just thinking back over everything that we've been talking about, the stock markets are really long-term the best investment, as according to what we've been looking at and
Definitely, yes.
about, right? And what history has said, right?
Yes.
So when the market goes down, like we are seeing it happen and is being predicted by Bank of America, as an investor, instead of me just becoming paralyzed with fear because of the downturn, if I'm a long-term investor, I should be looking to buy at that point in time because it's going to rally.
Yes, exactly.
Right?
Exactly. Yeah. And we'll talk about that in our education classes. Exactly. So again, the price is going up and down is a measure of risk, which we'll talk about. And again, if you understand risk, when the price is going down, eventually it comes back up.
Kiva has her hands up.
Exactly. Yes, Kiva.
Hi, good morning, Professor Keith. So my question is, I understand when the market goes down, then you buy, and pretty much you're not buying to resell, you're buying to hold it. But then what do the numbers, can you tell again what the numbers mean for what to look out for the 43.30 and the 42.58? I wasn't clear on that. Thanks.
Right. So if you look in any, Yahoo Finance or anything, the S&P 500 index closed at 4308 on Friday. So on Monday, the market will open and the S&P 500 index will either go up or down depending on the price performance of the 500 companies in the index. So it's just below this 4330. So again, there's more uncertainty now. Will it go higher or lower in the future? If it goes above 4330, then that's called the support, and there's a higher probability it will keep going higher because it made the support level, and now we have some resistance for it to go lower than 4330. If it doesn't hit 4330 though, and it keeps going lower, then it's like, well, the probability is that it will go lower. So again, this is why 4330 is a key number. Either way, but again, you should be investing incrementally no matter what's going on because it's so hard to time the market, and we'll talk about that. But again, for the short term, I want to look at 4330. If it doesn't make 4330, it better not go as low as 4114.
So is that the overall health of the index, you would say?
Yes. Yes. But this is going to reflect the market because you have 500 of the biggest U.S. companies. So, think of it this way. We want it to stay above 4114 because if it goes lower than that, it's going to keep going down. And we would like it to get above 4330 because that means there's a higher probability that it will keep going higher. Okay. So that's the way you want to think about it. And these are just rough estimates, but they give you some idea. The next article was also from CNBC, and it talked about expect a violent upside rally before year end. Now, Tom Lee is a famous analyst on Wall Street, but he's what's called a bull. He's always optimistic about what's going to happen with the market. Again, and he follows our rule, right? When he says, look, at the best time to like make money is after the market shows this fear, which is this downward trend. Now, again, why are we having this downward trend? Because people are afraid, because, you know, like on Friday, right? On Friday, economists expected about 187 jobs being created, and there were over 330,000 jobs being created. The economy's booming, right? We would think that is good, but it's not, because the Fed's trying to slow it down, and so they keep increasing interest rates, because eventually that will slow it down. Again, you know, it's usually housing where it has the first effect, and we're seeing that now, right? Because mortgage rates have gone from 3% to over 7%.
Right.
Because the Fed keeps increasing their rates. So, you know, people are slowing down buying houses. And that's what the Fed wants. So one reason that the market keeps going down is the yields keep going up. And so if the yields keep going up, that means the Fed will increase rates in the future, and that's bad for the market. So that's a big fear. And then if the Fed keeps increasing rates, at some point we'll enter a recession. So again, everyone was scared of a recession early in the year. Then late spring and the summer, it looked like we were off a recession and we were going to get what we call a soft landing. But now people are scared of a recession again because of the increasing interest rates and the Fed's talking tough. So again, the market's going down. One reason the market's going down is because bond yields keep going up, right? About 18 months ago, you could have gotten a 10-year bond from the U.S. government, and the U.S. government would have paid you about 1.75%. So you would have agreed that for 10 years, you get 1.75% a year. Today, the U.S. government will pay you well over 4% for that same bond. So again, as bond yields continue to climb, they pull money from the stock market, so the prices go down. But again, and we're going to see this in our class, right? I mean, bonds are maybe attractive for the short term, but in the long run, and I'm talking about, 20 years or so, stocks always outperform bonds, always. So, stocks, again, if you have the long-term outlook, they're still a better long-term investment. Okay. So again, we talked about the nominal return being about 8% a year. He's saying because the market's been going down, when it turns around, it's going to increase by another 10%. And you can see that he's predicting a reading of over 4,800. Right? So, and this is by December. So right now it's 4308. That's over a 10% return. So he's saying that the S&P 500 index is going to go up by more than 10% before January 1st. So that's a bold prediction. But again, we've seen it. And again, even on Friday, the S&P gained 1.18% in one day, right? So if you had bought the S&P on Thursday, after Friday closed, you would have been 1.18% more wealthy. Now this How much time do I have here? I have time. So we're going to talk about this in our class, but what's important to understand is fees, small differences in fees make huge differences in your investment amount. Because these small differences in fees, they get compounded year after year after year. So again, this is why we're going to tell you, you always have to watch your fees, because even small differences, people say, oh, it's such a small difference. It's not. If you leave your money there for 20 years, it's compounded for 20 years. So you always want to watch fees. So, you know, we talked about 401ks, and we just had an article last session saying that, you know, half the people don't know what's in their 401k and so forth. But we always say 401ks, when you leave a job, you want to pull your money from 401k because the fees are way too high. In here, this article talked about the average fee for an index fund is 0.27 when it's in a 401k. When it's just in an IRA account, it's you know 0.04. So I had to speak to this group, and you know, I basically told them it was a banking group, right? And I said it's a fee, stupid. That's what's causing people's value to go down, because these fees are way too high. And if banks would lower the fees on 401ks, people would have a lot more money in their retirement account, a lot more. I mean, you can see there's no reason why the average fee should be this high for an index fund. It should be below 0.1 or 10%. It's almost 3 times as high. And then actively managed funds are even higher. And most 401ks are actively managed funds. So we'll talk about this in greater detail. But again, I just want to remind people, you really have to watch out for fees, because even small differences over long periods of time make huge differences in your returns. Huge.
Quick question. Could you just repeat the statement that you made about, you said that even though we've got jobs, the government wants to cool that down by increasing interest rates? Why would they want to cool down job creation?
Well,
or did I get that wrong?
No, that's true. So the trouble with job creation is it basically causes supply to increase while, let's say, your demand is constant, right? What does that mean? Well, it means that if you want to hire someone, you generally have to offer higher wages, because if you don't, they'll just go work somewhere else because there's all these jobs. Okay, and higher wages drives inflation, because they pay higher wages, and then they'll pass it on to the consumer. So like with this auto strike, right? Netflix, or even look at the writer's strike, right? Netflix is talking about they're increasing their monthly subscription rate because they have to pay their writers more. So that's the trouble with the job creation. If you create too many jobs too quickly, there's not enough people to fill them. And then how do you get people to take your job? You have to increase wages. And when you increase wages, you increase inflation.
Whereas, wouldn't you say that if you have more jobs, it also means more people are paying taxes? So it means more revenue for the government? I mean, I might have
Well,
this
no, because
wrong.
some of those jobs may not be filled, right?
Gotcha. Okay, got it.
Yeah, I mean, some of the jobs may not be filled. So, okay. All right. I know that's the thing, sometimes, and we're in one of those periods, right? Good news is bad news.
So
Right.
job creation does not equal employment.
No, in fact, it causes, to employ people, you have to pay them higher wages because there's more supply than demand. right?
yeah.
So that's the whole thing, right? So, you know, we created all these jobs, our economy's booming, and the market initially went down. If that job number, if they had predicted 175, thousand jobs, and if that job number had come in at 100,000, the market would have just shot up because they would have said, oh, well, the Fed's not going to increase rates because we're slowing down job growth. So again, we're just in that situation now where good news is actually bad news because it means that the Fed will have to keep increasing rates. But usually we want the unemployment rate to drop, right? We don't want the unemployment rate to drop. If it drops, the market will go down. We want it to increase some because that means that the wage growth will be slowing and lower inflation in the future. Okay, questions? Okay, now the second part after, we look at the market and then we, education is we have two portfolios, and these are sort of example portfolios, and they're portfolios based on what's called value or growth, right? So you can classify companies as value stocks or growth stocks. Growth stocks means that the price keeps increasing because we expect sales to keep increasing, right? So Apple, why does Apple's price keep increasing? Because we expect them to sell more and more and more at higher prices, right? Why does Amazon's stock price keep increasing? Because we see them selling more and more and more. And now they're in cloud computing, and now they're putting satellites up for internet service, right? NVIDIA's price is, more, it's up well over 100% this year. Why? Because NVIDIA has the chips for artificial intelligence, and we see artificial intelligence keep growing. So those are called growth stocks. Their stock price is based on expectations of what will happen in the future. The other type of stocks are value stocks. And value stocks are called value stocks generally because they're not growing as much, but they may be paying like high dividends. So they may be returning a lot of money to their shareholders. Or they may be undervalued for some reason, right? So there's one measure called book value of a company. What book value means is if I took all the company's assets, so if I took GM and I sold all GM's plants and their buildings and their equipment, and I just sold everything off in the market, how much money would I have? Again, that's called book value. Now, market value is generally, well, how much is the company worth according to the market? I mean, a lot of companies are well above book value. I mean, Apple's market value is, I'd say, probably about 50% higher than its asset base if we sold off Apple. Okay. But, some companies like banks, like there's some banks because of the run on banks, because of those regional banks, because of the Silicon Valley banks. There's some banks whose book value is higher than their market value. I mean, that's just crazy, right? Why would the market value be lower? Because in theory, you could just sell that entire bank off and you would get more money than what the market values it at. So those are called value stocks. For some reason, they seem to be underpriced. Okay, so we can divide all stocks into, is this a value stock or a growth stock? And then we look to see what's a relative performance. Last year, as our veterans will know, value outperforms growth. So value did better than growth. So here we have our value portfolio. Okay, this first stock here, this is a real estate fund. So it owns a whole bunch of real estate. This is just, the prices and so forth. So you can see it finished on Thursday at 76.27 a share. So for the year, it's up about 6.5%. This is our healthcare ETF. These are all healthcare companies. It finished at 60.43. That's off about 5.5%. This is managed futures. I don't have time to explain now, but this is not the stock market. Why do we have it here? Because we're diversifying, what's called diversifying. So generally speaking, when all these other ETFs are going down in price, this one will be going up in price. So this closed at 31.80 a share. So you can see it's up about 4% for the year. This is a large cap companies, which are value companies, and they're chosen by artificial intelligence, right? So this is what's called an actively managed fund. This artificial intelligence decides what companies go into this fund. That ended at 30.20 a share. That's off about 4% for the year. This is just a large cap value index of Schwab. These are all large cap. JP Morgan, Berkshire, that's Warren Buffett stock. You would probably have like Merck, the pharmaceuticals, energy companies would be here. That ended at 63.08 a share. That's off almost 4.5. This is small cap value. These are just smaller companies. That finished at 155 a share. That's off about 2 1/3. And finally, financials. These are all financial companies. Financials are value stocks. They pay high dividends, and their market value is very close to their book value. That finished at 32.78, so that's off about 4% for the year. So you can see overall, right, our average ETF in our value portfolio has lost about 3.25%. And in fact, you can see all the ETFs are losing for the year except this managed futures, which is why we have it here, because if they're losing, this should be gaining, and it is. Also notice the change from the 23rd. You can see, again, the market's been going down, and we really see that. Okay. Now we want to look at our growth portfolio. So this is the ARK ETF. This is sort of a bellwether for the high-tech firms. That finished at 38.54 share. That's up about 23.5 for the year. Now I want to point out at one point it was up 50%, right? So at the end of July, it was up 50% for the year. So again, it's up 23, but it's down from where it was. This is digital health. So this is in the healthcare, but it's more specified. There's only digital health companies, Teladoc, the glucose monitor, Dexcom, and so forth would be in this fund. That finished at $16.47 a share. That's off over 12.5. We have our cybersecurity companies, Hack. That finished at $50.79 a share. That's up over 15% for the year. We have our smart factories, robotics, and so forth. That finished at $32.25 a share. That's up about 5 1/3. We have our clean energy companies. That finished at $38.89 a share. This is a 52-week low. So this is the lowest this price has been in a year. Notice that it's off over 17.5%. There's just an article saying that these high interest rates are hurting these clean energy companies because they can't get financing, or the financing is so expensive. We have our Schwab large cap growth companies finished at 73.08 a share. So this is up about 31.5%. So again, another index company where you could be earning over 31% a year. And this is our cloud computing ETF, finished at 74.47. That's up about 29.25. So you can see on average, each ETF in our growth portfolio earns us about 10.5%. You can see we have 2 losers though. Notice back on July 6th, all the growth companies were positive for the year. So again, we're seeing a little deterioration in the market, but growth is still outperforming value. Okay. Again, you can see growth has dropped. Look at this, was September 14th, growth is up 20%. I mean, that was only about 4 weeks ago, right? And it almost got cut in half now. Okay, so again, we're just trying to look at, well, how's growth doing? How's value stocks doing? You want both valuing and growth in your portfolio. Notice if you have the S&P 500 index, it's called a blended fund that has both growth and value. Okay, then since we just finished the end of quarter 3, September 30th was the end of quarter 3, we want to look at how our sort of bigger portfolio is doing. So we have a bigger portfolio we've been following for several years, and we break them into categories. So all these ETFs represent an index. These are all index funds. So again, within index funds, these are very low cost funds. We use the Vanguard 500 index, but if we use the Fidelity 500 index, the return would basically be the same. Again, any S&P 500 fund is going to have the same companies in it. Okay, so you can see I've got quarter 1 return, quarter 2 return year to date, quarter 3 return year to date. And here I'm just showing you last year. So you can see our ETF ONEQ, which represents the NASDAQ index. At the end of quarter 3, this was up about 27%. Our small cap, this is the Vanguard small cap index. End of quarter 3 was up 3%. This is the mid cap, up just over 2%. S&P 500 was up 11.75%. The total market, this is an index which covers the total market, that was up over 11%. This is the Vanguard Value Index, so these are all large cap value companies. That's down about 1.75% for the year. These are all large cap growth companies. You can see that's up about 28% for the year. International index, that's up about 3.5%. Emerging markets, that's up about 0.5%. This is small cap growth, that's up almost 7%. And then this is another measure of small cap. This is the S&P 600, it's called. That's off just a fraction. Okay.
Keith,
Now you can see that all these indexes dropped from the end of quarter 2. So this was July 1st. This is basically October 1st. And you can see they all dropped. All did work.
sorry.
Yeah, go ahead.
With regards to these stocks, I mean, I've been watching this over the last couple of years, but I've never had the chance to ask, are they all, do you have the same amount of shares in each ETF, or do you have like roughly the same amount of dollars in each ETF? How is it kind of broken down?
Yeah, it's usually
like if
money.
I were to try to
It's usually dollars.
Okay, so because if I were to try to recreate this, do it based like 1,000, and then take it from there.
Yeah, I do have a percentage. You always want the most in the S&P 500. That's always your foundation, because you're
Okay.
betting on the 500 biggest U.S. companies.
Yeah. Okay. Well, I now have access to a NASDAQ fund, so I'm going to try to take advantage of that.
Yeah.
I didn't have that before.
Yeah.
Okay, thank you.
You're welcome. So on the median return is 3.48. Again, as we'll learn in our education classes, index funds outperform actively managed funds. So this is what we're shooting for. We want a return of at least 3.448. Otherwise, we would just put our money in index funds. Okay, now these are called sector funds. So again, these are all companies in one sector. So you see the fintech sector is up about 35 2/3%. Genomics or biotech, that's up about 1 1/3. This is robotics, that's up about 28%. This is battery, these are battery manufacturers. That's up about 3 3/4. Here's our real estate ETF. That's off about 4 2/3. BitQ, this is one crypto ETF. You can see that's up over 97%. Although, you know, remember last year though, it was down about 90%. This is our another crypto ETF that's up about 32%. This is our semiconductor ETF that's up about 27. This is autonomous vehicles that's up almost 5. Hydrogen fuel. This is the hydrogen fuel cells. That's off about 17 3/4. Energy is off about 8 1/2. Financials are off about 2 3/4. Information technology, that's up about 36.5%. Our cloud computing ETF is up about 26%. And finally, this is the minerals and the metals that go in the batteries. That's off almost 7%. Whoops, yeah. I'm sorry, that's off almost 11%. Again, you can see for all these sector funds, right? We had a drop from the end of Q2 to Q3. I mean, some of these are big drops. This BitQ was up over 135%, and now it's like 97. Look at genomics, it was up almost 21, and now it's off. So again, you can see Q3 was a down quarter, right? Still, you know, the median slightly beats our index at 4.8. We'll have to see if this holds throughout the entire year. But also notice, you know, you have a lot of losers here, right? It's almost like in sectors you want to diversify too, because you can see you have some losers here. Okay. Let me, whoops, I'm past my time. Okay, so again, this is just slightly better. I don't want to rush through this because we have some new people, so I'll go through the rest of this next week. I better stop here because I'm past my time. Okay. Any questions? Okay. Everyone, thanks a lot for coming. You know, hope to see you in 2 weeks. Again, we thank the Shawn Carter Foundation. If you want to make a one-on-one appointment with me, just, you know, sign up at my link. And we'll see you in 2 weeks.
Thank you, Keith.
See you in 2 weeks, everyone. Please.
Thank you. Tell your friends, please.
Thank
Will
you.
do.
Bye-bye.
Yeah.